Today in this video, we're going to talk about how to buy a house in 2026, especially for those first-time home buyers. Check it out. Hi, I'm Rhonda Burgess. I'm a mortgage underwriter here in the Nashville, Tennessee area, and I've been an underwriter for about 25 plus years. Okay, today in this video, I saw an article from USA Today, and I wanted to just address some of the things that I found in this article. Okay, so let me pull it up and look on my other screen right quick. Okay, so this is from USA Today, and this was from FICO, the credit score people. It said, according to credit scoring company FICO, 59% of Americans said in a survey shared with USA Today that they don't fully understand the steps involved in buying a home. And the figure rises to 64% among first-time home buyers. It said about 1 in 5 Americans, including 1 in 4 prospective home buyers, also underestimate how significantly credit scores affect mortgage rates. So in this said that the first thing that buyers should do is they should know what their credit score is. I agree and disagree with that point. Y'all know on this channel, I've always talked about, I got a bunch of videos about buying a house, how to buy a house, how to buy your first home, different stuff like this. Okay, so I'm going to take it from the look of the underwriter. Yes, your credit score is important. Your credit score is important. Like I've always told y'all, do your homework. Do not wake up tomorrow, Monday, and just decide you're going to buy a house, because it don't work like that. You need to do the background work first, okay? Yes, it is important to know your credit score. It is very important to know your credit score. Inevitably, every time I do a credit score video, and I'll say you need a 660 or higher, there is somebody in the comments that'll go, now you only need a 580. I bought a house with a 620, and I bought a house with a 600, and da-da-da-da-da. Okay, but I'm going to tell you, for those of you who bought at a 580, for those of you who bought at a 620, those of you who bought anything with less than a 660 credit score, you didn't get the best rate. I didn't say you couldn't buy a house. I want you to listen to what I'm saying about the credit score. You need a credit score of 660 or higher. That's going to get you the best interest rate. That's going to get you the best parameters to get your mortgage approved. Because listen, when you have a 580 credit score, you are barely there. You know what I'm saying? You are barely there. You can fog a mirror if they put it under your nose, but that's about all that you can do with a 580 credit score. The problem is when you have that 580 credit score, there's a bump on the interest rate. So if the going rate for those with a 660 or higher is, let's just say 6%, I'm going to use an even number, 6% even, then you're probably looking at a 7. There's a bump on the interest rate when your credit score is below a 660. I'm only telling you this from the underwriter's point of view, from your underwriter and your originator's point of view, okay? Because they've got to price in, meaning they've got to increase that interest rate to offset that you're a higher risk because you only have a 580 score. Remember, when you're looking at FHA guidelines, for example, it do say the minimum is 580, but you're hard pressed to find the lender who will take on that risk because you are a higher risk of default because you have a lower credit score. Okay? That's just what it is. So yes, you do need to know what your credit score is, and you do need a 660 or higher score, in my opinion. Now, I understand if you're having to relocate because you need to go home and take care of mom and them, or you relocating for a job, or you're relocating in the military, or whatever your situation is, and you got to move right now. So you've got to secure housing right now, and you're wanting to buy a property, then you may not have time to get that score up to a 660. But again, if you're starting 6 to 12 months ahead of time, you've got time to get that credit score up. Okay, that's just and there's no excuse for it. You know what I'm saying? There's just no excuse for it. Okay, I'm gonna have a link in the description for the smart credit. thing where you can track your credit score, and it can show you what you need to do to, boost your score and different stuff, how you can pay down debt and when to pay the debt and all that good stuff. Okay. So that's that. But you need a 660 or higher score. You really need a 700. Just to be quite honest. If you want the best interest rate, if you want the best terms. Also, when you have that lower credit score, like you got a 580 credit score, you got a shorter debt to income on the back. Meaning, your debt to income ratio is going to be less than someone with a 700 credit score. Because see, the credit score just demonstrates that you know how to manage your debt. That's all it is that you have in the past paid debt back on time. Okay, sorry about that. As I was saying, when you have, you may have a tighter debt to income ratio when you have a lower credit score. So yes, the first thing you need to do is make sure that your credit score is as high as possible. If there is something you need to get cleared off or whatever, you need to figure it out so that you can get that score up. Okay. That was one of the things it talked about. But to me, not only, I did a video, I think last year, and I'll link it, where I said, I run into people all the time have high 700s, 800 credit score, debt to income out of whack, debt to income. The credit score only gets you so far. Let me say it like that. Because if your debt to income is out of whack, it's never going to work. It doesn't matter. Like I said, you can have an 800 credit score. I get people all the time that make good money. Y'all will call me and tell me, yeah, I got turned down by this lender. I got turned down by that lender. And I'm like, the problem, and then you say, I have a 750 credit score. Okay, then it's your debt to income. 9 times out of 10, it's your debt to income. It's not the property, it's the debt to income. So that's the other thing you need to do is sit down and look at and calculate out your debt to your income. Okay. I had a young man that was referred to me by one of my previous clients. I sold this lady a house about 10 years ago. Okay. We still keep in touch, follow each other on Facebook, different stuff like this. She sent her son to me. Okay, cool. And he's telling me I don't have no debt. Okay, cool. He wants to buy a house. Okay, cool. You need to be able to calculate your income. You need to be able to calculate your income. Okay. Now, for a lot of people, it's your standard. Are you working 40 hours a week times $20 an hour? What are we doing? That's 800 a week times 52 weeks divided by 12. That's how much your monthly income is. But a lot of us may not be paid like that. If you're salaried, if you're making, $60,000 a year, that's $5,000 a month. That's your income. I know we have a lot of medical professionals where you may work a different schedule. You may work 3/12s in a week, and then, you rotate on that weekend. You need to calculate how much on average you're making per week. So that way you have a correct debt to income ratio to go off of. So this young man that I'm talking about, I say, so how long you been on your job? He said like 2-3 years. Okay, cool. All right. So he tells me he makes whatever amount. I'm just going to put out, let's say $30 an hour. Wonderful. Okay. So I'm thinking, cool. And I say, you work full time? Yes. And then he says, well, I guess it's full time. Okay. The work that he does, he gets paid per assignment or per job or per task, whatever, you know what I'm trying to say, which is not uncommon. It used to be a lot more common, especially in like manufacturing. Okay. You would have people that, got paid piecemeal, meaning, how many products they produced that day is how they got paid. That wasn't uncommon back then. Okay. Now it is, because we just have less factory workers, and a lot of your factory workers are now just on an hourly. But what he does, he's more like a maintenance person. Okay. So long story short, when everything was said and done, he's only averaging 22 hours a week. When you break it down. Okay. When you take how much he's making, on those assignments, and then divide it by by, divided by 40 hours, because that's still what the mortgage people are going to go off of. Okay. So he was only averaging 22 hours a week, made good money per hour, but he was only averaging 22 hours per week, which means he could only qualify for $125,000, which he can't buy anything in this market. Nothing at all. So don't get your hopes up if you're not sure about how much money you make. You may have the best credit score in the world and no debt. That's wonderful. But you need to know exactly how much you make if you're looking at a 40-hour a week, work week, because that's what they're going to calculate it on. Now, when you are, self-employed, that's different. Self-employed, or you're doing the gig work, that's different. That's a different way to calculate that. But for the people who work a W-2 job, you need to know how you are being paid and how to calculate your income. Okay. Okay. So once you get figured out how much you make per week or per hour or per month, however, once you have confirmed your income, then you need to look at your debt. And by debt, I mean the minimum payment on your revolving credit. Your revolving credit would be your MasterCard, your Visa, your Discover, your American Express, Diners Club, if you got that one. Your revolving debt, any installment loans like a car, like a student loan, a personal loan that you got, a consolidation loan that you got, any installment debt. Remember, your revolving is going to look at the minimum payment. So if you normally pay $300 a month on your credit card because you got a $10,000 balance, that's cool. But the only thing you're going to use to calculate is that minimum payment. Let's say the minimum payment is $100. So you would only include $100 in that minimum payment instead of $300. Okay. It's always going to be the minimum payment. It's what's used to calculate your debt to income ratio. For the majority of people are carrying some type of debt, and it's your debt to income that's got you jacked up. So if your debt to income ratio is too high, right? A lot of people, you're priced out before we even put the mortgage payment in there. Okay. So again, I'm going to link a video I did about how to calculate your debt to income ratio. If your debt to income ratio is too high, there's only two things that you can do. You either, one, got to increase your income, or two, you got to reduce the debt. Period. There is no other way. You can't do that new math on this stuff. You can't do it. It's not going to work. So what you need to do, I have people all the time that tell me, okay, well, I will get a second job. I'll give me a part-time job. I will do DoorDash. I will do Uber. I will do whatever I have to do. Cool. If that's what you're going to do and you're just now starting it, then what you need to do is just take that money and pay down that debt. Don't worry about trying to include that money as income. I'm going to say it again for the people in the back. If you're just now starting and you're looking to buy something in the next 6 to 12 months, don't worry about including that money as income. You just need to take it and pay down that debt, because you've got to have a 2-year history of working that job, and you've got to pay taxes on it for it to count as income. Again, just use that money to pay down that debt. Just pay down the debt. If I was you, personally, if you just now started, and let's say you started, at the beginning of this year, you started in January of 26, and you're looking to buy something by the end of the year, I wouldn't even include it as income. I would just take it and pay down my debt. Or I would put it in a savings account, put it in another checking account, and use it towards my closing costs or my down payment, because you will not have a 2-year history. And most people, let's just be honest, you're going to write it all off, because you're going to write off your gas, your maintenance, your this, your that. Just use it to pay down the debt and put that money in a bank account somewhere, just so you can have your down payment and or closing cost money. Don't worry about trying to include it as insurance, as income, because it's just not going to work until you have a 2-year history and you still cannot write it all off for it to count. So again, in my opinion, those are the 2 things you need to start with when you're looking to buy a house. Coming from an underwriter, you want to make sure that your credit score is as high as possible. Do whatever you need to do to get that credit score up. Even when people say, well, I don't have no credit score, so I'll be fine. Nope, you're still gonna get a hit. There's a hit on the interest rate when you do not have a score. So it's best to have a score. If you need to start off with some secured credit, I got a link in the description. Get you some secured credit cards. Revolving credit is what moves your credit score. Revolving credit is what moves your credit score. Okay? So what you need to do then is start establishing you a credit score if you do not have one. Okay? You want to get your credit score up as high as possible, and then you need to look at your income. You need to look at your income. Make sure you've calculated out how much you make per week, per hour. And then compare that income to your debt. This is the only way you're going to be able to get started. In my next video, I'm going to talk about what we look at when we pull your credit, and we're looking at the credit score, and we're looking at everything. But those are the 2 things you need to do as your own personal homework before you even start to call lenders or really even think about buying a home. Can you afford to buy a home? Can you afford it based on your own debt to income? If you are buying with a co-borrower, whether that's your spouse, your boyfriend, girlfriend, your plus one, your significant other, your mom and them, your brother, your sister, your dad and them, whatever, you need to make sure that you look at their information too. It's nothing worse than you getting all excited. You go out, you start looking at houses. You done found you an agent to work with. You looking at houses because in your mind you thinking you got it all together and you're nowhere close. So again, make sure you look at your income, your debts, and if you're using a co-signer, a co-borrower with you, make sure that you look at their information also. As always, thank you and have a blessed day.